everyone involved in bringing us the Tough Tech Summit this year. We have seen some incredible conversations since the summit began, and I am very excited to continue the discussion today on the future of investing with Carmichael Roberts, Dipender Saluja, and Jonathan Solomon. I'm Meeta Kapadia, and I'm part of the VC relationship team at Silicon Valley Bank. For those of you who are not familiar, SVB has been working with founders and investors across the innovation economy for 35 years. Our panelists are known to many of you through their extensive work in the tough tech space. I'll start with Carmichael. Carmichael Roberts is co-founder and managing partner of Material Impact, a fund that seeks out transformative technologies and builds them into enduring companies that solve real-world problems. His current investments include soft robotics and zero mass water. He's had a successful career as an entrepreneur and investor, and is also a member of Breakthrough Energy Ventures, a mission-oriented group committed to changing the world by creating and building companies that address the threat of climate change. Carmichael serves on the boards for the National Venture Capital Association and Massachusetts General Hospital Physician Organization. Our second panelist is Dipender Saluja. He's the managing partner of the Technology Impact Fund and managing director of Capricorn Investment Group, an investment firm founded to invest profitably while also driving sustainable positive change. Some of Capricorn's past and current investments include Tesla, Planet, Joby, SpaceX, Redwood Materials, Twitter, Forum, and Helion. He's an electrical engineer by training and is a commissioner of the Global Commission to End Energy Poverty, and he serves on the boards of many companies within the tough tech space. Dipender is on the Leadership Council of Cyclotron Road and on the Investment Committee of Prime. And our third panelist is Jonathan Solomon. Jonathan is the CEO of BiomeX, a microbiome company developing custom phage therapies to eradicate harmful bacteria in chronic diseases. Prior to his role in BiomeX, Jonathan was a co-founder, president, and CEO of Proclera, which is pioneering an approach to treating neurodegenerative diseases. Under his leadership, the company raised more than $100 million and launched an ongoing clinical trial related to Alzheimer's disease. Prior to that, he participated in the elite Israeli Defense Forces and served for 10 years in a classified military unit. You can read more about these three very impressive panelists in the program notes. Oh, and I can't forget to remind you to please send in any questions throughout the discussion by typing them into the chat session at the right-hand side of the screen, and we'll do our best to answer them. All right, gentlemen, let's dig right into who's engaged in tough tech today. We have seen some really interesting shifts in both founders and investors in this space over the years. New founders are entering the market, including successful entrepreneurs and seasoned operators from other sectors. Matt and Alon talked about this a bit in their very inspiring fireside yesterday, and a call to action for entrepreneurs to join the fight to solve our most pressing problems. So for the first question, Dipender and Carmichael, I would love your perspectives as investors on the types of new founders you're seeing. And the two of you have been involved in this space for over 15 years, like well before it became popular through to where it is today. And both of you got your start actually building companies yourselves. One example that came up during our prep call is Redwood Materials, where you recently co-invested in someone trying something new. So the question is, what do you think is the primary motivation of newcomers in this space? And can you share some of your experiences of investing in these founders? And, as a, general sense, what message would you like to share with these new founders with strong ideas? So either one of you can start.
Okay, I see Dipender still muted, so I'll start. And I think you can probably fill in just as easily. So first, you're so right. It was really one of the most exciting things about what I've seen in the last few years. I would say broadly in tough tech, which crosses over to things obviously like climate. It's just the number of amazing entrepreneurs who want to work in the space. And so let's first define, to answer your question, let's define a little bit about what newcomers means. So there are two types of newcomers that I see. Those who historically haven't really worked in tough tech, per se, and in topics like climate. And those who have actually been working, but have decided to do something transformative, and maybe for the first time are starting a company, being CEO and getting something off the ground. And there are two different types of newcomers. And then lots of people that I see coming in doing that. And if I had to describe it a bit in terms of the phenotype, if you will, on the side of not having been in tough tech or maybe working in climate, I see people who have been in what they would call traditional tech, deciding that they want to come over and work on the tough tech problems to really make the world a better place and also build big businesses. And they're seeing that. So it's not just social motivated and mission motivated. I think that's a lot of it. I think they're sort of asking themselves at this point in time in their lives, besides making a big economic benefit and big returns and creating jobs, what else are they solving in terms of the fundamental problem? That's certainly a major motivation. I've seen several people talk in this conference around that. By the way, you mentioned Matt Rogers and Elon. We're working closely with Matt on things as well with Chewy. He's a prime example. But now I'm going to try and transition over to Depender on this next piece. But then you look at the second category of people who have been working on these problems all along, but then see a derivative problem that's just as big and decide to go and attack it and be a CEO and start something new. That would be the example like you gave in Redwood. And I'm seeing lots of that as well. And it's so Depender, maybe you can take it from there.
Sure, I agree with everything Carmichael said. I think part of the reason why people are thinking about new entrants is that we've had a period of 10 or 15 years where because of a lot of tough tech that was done in the decades prior, it's been teed up to build companies faster and easier, primarily driven by the developments in software and the internet. And so, I just completed 33 years here in Silicon Valley. And when I moved here initially, all tech was tough tech. There was very little easy tech, if you may. It was mainly about hardware. It was about the early days of workstations, and nobody had heard of a smartphone or even the Palm Pilot at that time, right? So those were the days of deep semiconductor innovation, systems innovation, biotech, materials, and more to come. It's really over the last 15 years that I think people have enjoyed this period of being able to do companies with very little capital, very quickly, with most of the foundational stuff built for them, and then being able to evolve these business models. So to some extent, I see this more like going back to building things that didn't get attention for 15 years because there was a lot of other stuff to do. It isn't good or bad. It's just, water flows where it can easily. And that's how sort of the capital, money, and entrepreneurs flow. Now, I love what one of the founders here in Silicon Valley said a few years ago, which was we were promised flying cars, and all we got was 140 characters. The fun thing is, we've had the pleasure of being involved with the 140 character company and with the flying car company, and we can see what it takes to innovate in both those places. But we're seeing a lot of people who have sort of done the 140 characters and now say, I want to go back and really do something meaningful and tough, and are coming back and literally and figuratively building flying cars now.
Are there for the new people coming into the space, are there certain skills or different things they're bringing to the table, or is there what type of extra support do you think they need in order to be successful today and maybe going forward? And I would love to hear about your experience with Redwood Materials. I mean, this is not an inexperienced founder, but someone trying something new.
So Redwood is actually maybe not the best example of this new entrepreneur, if you may. For those of you who know JB, we've known him for 25 years, and He's always been almost a metaphor for what it takes to solve large systems problems. You know, I first got to know him when he was doing the solar car at Stanford, and the solar car was sort of, again, an example of something that was multidisciplinary. It was electrical engineering, mechanical engineering, it was software, it was physics. It was a lot of stuff that had to come together. It was almost like, you know, how do you bring everything, all disciplines together to make something work? And so he's probably one of those rare individuals that has always been well known, you know, to be able to solve a problem like that. And so for us, of course, it was a wonderful thing to be able to partner with Dave and Carmichael and Kyle at BV and JB, of course, and do something that was full circle for us a decade and a half after we had originally invested in JB when he founded Tesla. And I think that's an example of him evolving, where he initially was very clear that the biggest problem for electric vehicles a decade and a half ago was batteries, and did an amazing job of solving that problem to build what is undoubtedly the best electric car in the world today with the best application of battery technology. And then very quickly realized that his success and that car's success was going to spawn that move to electric vehicles that we'd all been waiting for a long time. And this was going to lead to this big challenge of what do we do with all these batteries that are going to come out of these cars? And it was going to lead to this huge opportunity of responsibly recycling these batteries, making this much more sustainable, much cheaper, and faster. Materials were going to come from, and where the batteries were going to get built, and also let a lot of countries around the world feel somewhat secure about their raw material supply, so that they didn't have to constantly wait for the countries that all this material gets mined in. So, I mean, this is probably an example which is one of a kind, where somebody who is responsible for the birth of one industry then comes in and really innovates in the side effects of that industry, which is also a large mushrooming opportunity.
Yeah, and if I were to pick up from that, agree with everything that Deepinder said, and then if I would say, we're ever so fortunate to have an opportunity to work with somebody like JB who's got that experience. And then there are a bunch of phenomenal people who aren't out of central casting, so to speak, for these sorts of companies. But I mean, I often get asked the question, what do you invest in? Carmichael, what do you look for, whether we're looking through the lens of breakthrough energy or whether we're looking at material impact or even in my past? And what's inherent in tough tech is that we're solving some of the world's biggest problems and have with the opportunity to build some of the biggest businesses. So typically the problem in the market is self-evident, but then the question is, what are the 2 or 3 things that are going to be pivotal to solve, that are customized to each of these business opportunities? And then you look at the team and you ask yourself, is this individual or these set of individuals, are they uniquely suited to at least address one of those 2 things or 2 of those 4 things, something unusual about those individuals? And you can come from another area outside of quote unquote tough tech and possess something that's unique, that when you see it and you combine it and you look at those problems that need to be solved, you can see it in the individual. And so you ask the question, for those who've been traditionally outside and they come in, how do we view them? If they come from the outside and I can't see anything that's unique in them to solve these problems, I begin to worry a little bit. I don't give up on it, but I worry. But most of the time, there's something unusual that they're bringing that you can kind of connect the abstract dots and say, this person can do something impressive. And then you ask the other question, like, what do you do in that circumstance to maybe deal with the other 2 things that, they're not uniquely suited for? Well, that's what every startup, right? Inherent in every company, you're resource limited in some direction, whether it's money, capability and scaling, unique knowledge and the technical side, you know, the list goes on. And what we do then is hopefully you're more than just money. Hopefully at that point in time, especially when you think about, like, you know, I'll speak up for Depender, even like someone like Depender who has been involved for so long in helping people build companies. And, you know, I like to believe I fashion myself in the same category. Then we go out and do the work to kind of figure out how to surround, you know, the person with the resources so that they could be successful. And, you know, that could different, you know, it could be different if you're a business person or a technical person that's coming to, you know, to the party to start.
Yeah, that makes sense.
If I can jump in.
Yeah, please do.
Exactly. Maybe I'll provide the comic break here, because I've had the first company launching it, you know, without any background. No one was impressed with my classified unit background at all. And, you know, we had a few very rough years. So none of the big investors wanted to support the company. We had angels invest substantial amounts, which was quite a miracle to get the company off the ground. But it was very difficult. And now in hindsight, in my second company, when I got the big investors to come in, it actually makes a huge difference, right? So, and I think that's something people don't appreciate enough. It's really not just money, right? The investors bring connections, guidance, you know, insights, like, and we'll be talking about it later. We could actually go, in the second company, we could go public rather quickly, just with the backing and support of some of these credible investors. And that's something that you can't do. So I think it's a big challenge. It's a big challenge to kind of overcome that chasm, right? I think some people can see entrepreneurs that have the potential, but those that don't have the background, it's going to take a lot of grit to get there, right? It's not a simple task. Much easier in the second company. In the first one, brace yourself.
Well, we're glad that you persevered. I think this topic kind of shifts over to, or it flows pretty seamlessly to investors. So not only are we seeing new founders, people trying a lot of new things, but we're seeing a lot of changes within the investors in this space. So, you know, traditionally the capital stack here was, you know, you'd see the brand names like Khosla, Breakthrough Energy, Capricorn, and you'd also obviously see significant government funds and strategic corporates. But more recently, we've seen sovereign wealth funds making direct investments, family offices playing more significant roles, and also highly specialized emerging firms raising new funds. And then, as we talked during our prep call as well, ESG is playing a much more prominent role today, and is, you know, is almost part of every, you know, deck that we see. So similar to this first topic, I'd love to have this group talk about what you think is the driving force there, and if these changes are going to affect kind of that foundation of passion, patience, and commitment that have been hallmarks of the long-term players, the long-term investors in tough tech. So, you know, I guess Depender and Carmichael, I'll start with you, and I'd love to hear what you think the upside and or the downsides are to having, I don't know if it's newer or less experienced investors in the space, but changes in the space. And is competition changing, are investor dynamics changing? You know, what do you think about when putting these syndicates together?
Sure. So maybe the first part of your question, I think, you know, first and foremost, it has to do with, do investors see the opportunity to be successful in the space? Is the space going to return capital? That's what is the business of investors. And so I think one of the things that you are seeing is over the last few years, more recently, much to our delight, there have been several successes, and it's become very clear that this is a large market, and this isn't one of those things, you know, which was being brushed aside by sort of that short period where there were a bunch of visible failures, even though in totality, those failures were no different than any other industry. I can name a lot more enterprise software companies that went belly up than I can tough tech companies. It was just, you know, we've somehow politicized this space a lot more than some of the others, and there was a lot of media and conversation around it. And maybe because the stakes are high and there are a lot of incumbents that have something to lose, so there's a lot of sort of pushback. But I think first and foremost, it was that I think people can see real opportunity here. This is not a bad neighborhood as it was labeled for a while, and the smart investors are stepping up. And then number two, that feeling of the only way you can make money or be successful is to be quote unquote capital light. And that I think is a bit discouraging for a lot of entrepreneurs, because entrepreneurs hear that and they go, man, I want to build this, but maybe I should just do an app, or maybe I just do something super easy and digital. And if there are great ideas there, I mean, there are amazing business models that have evolved from that, but there's a bigger opportunity to do what we are talking about here, which is tough tech. And then I would say the ESG piece is definitely playing a role. I think there's lots of pools of capital that are stepping back and saying there are a lot of problems in this world, and there are lots of mainstream for-profit ways to go solve some of these problems. And there are lots of ways to get out of the Stone Age, even though we still have enough stones, and make progress, as has been done in the past. And those pools of capital, like the sovereign wealth funds and family offices and pension funds, and even regular investment firms, are starting to step up and increase that piece. On the family office side and the foundation side, and that space, what you've seen is traditionally people have said, I'll use my nonprofit dollars, the 5% of my endowment, if you may, to solve some of these problems. And what's exciting for people, and we beat the drum on this all the time, is that this is an opportunity to use the rest of the 95% that in the past has just been chasing whatever to actually bring in because of the returns possible. And then for the larger funds, before I hand it over to Carmichael, I would say the capital intensity of some of these projects is actually an attraction because they need to deploy capital. I don't know what the latest number is, maybe Carmichael or somebody else knows, but there's something like 15 or 17 trillion dollars of negative yield money out there in the world, where people are literally handing it over to projects that are going to lose less money than the other. It's not about making money, it's just about sort of preserving. And so there's a lot of capital that frankly needs to be deployed. And what could be a better place to deploy that capital than in solving some of these massive challenges, which are also massive opportunities, do good for the world, and create huge employment and economic opportunities at the same time.
I think well said. And if I take what we talked about previously, where the entrepreneurs are going, whether they're, quote unquote, historically from our area of tough tech, hard tech, deep tech, solving big problems, or whether they were, coming from other areas, you can see the best problem solvers coming in this area. Then you combine that with what Dipender said, which is unquestionable evidence of companies out there that have been successful in this area. Then you start to think a little bit more about, we can't help but think about it in 2020 with what we're dealing with COVID, and also when we start thinking about some of the other societal problems that have been prevalent that we've discussed. Like, people want to work on stuff and invest. Work doesn't just mean the entrepreneurs. Investors want to put money into things that yield competitive returns in whatever the financial category it is. So if it's venture, it's venture returns. But also on top of that, solves the problem, but also on top of that, does it in a way where we're all really good corporate model citizens and human beings. And all things being equal, you want all those things. And so we see the money coming in from the different categories. I think largely because the entrepreneurs are moving in this direction, and the evidence that Dipender mentioned that companies are showing this. But if we build on that a bit more, I'd say my career started off as an entrepreneur, once upon a time, I thought I was going to be a professor, candidly. So it was a technologist in me. That's what brought me to Boston. I was a fellow at Harvard. And from there, the entrepreneurial bug bit me. And my early career was really focused more on life sciences. And so, I gravitated over time to things like, agriculture and food and water and other things that mattered a lot to me. But I started off in life sciences. And when I started off there, and as a first-time CEO, we built big syndicates, and this is still true in the life science and the healthcare space. You built diverse syndicates with investors from all categories. So it's really interesting as we talk today, we say, well, geez, now we're seeing all these investors from all categories come towards these other set of areas. Well, for me, it was always where it had to go. So what I love about what I see today is, and I think I can speak for Breakthrough, and I can also speak for Material Impact in this regard. We measure success not only getting into the very best deals, focus on the very best problems, most important problems with the best entrepreneurs, but who are the syndicate partners that we can build around this? And how do we get as much attention and money into this category, where, as Jonathan said, it's not just money, where they can really help an entrepreneur be successful. So we're actively not only trying to figure out how we get into a deal, we're trying to figure out how we build syndicates in the right way, the way I saw it historically done in life sciences. And as a result, that has us working with the vendor, together, instead of by oneself. And if we look at a lot of the companies that I see done in the last few years, we're seeing a lot more collaboration, which by definition means getting a lot more unusual suspects on the finance side to come to the market. And Meeta, that question you asked about when it's an unusual founder, how do you, help them? Same with the investors. When it's an investor who comes into space, no one has, Depender's talked about 20-something years. There aren't many people like Depender who 20-something years been, in this thing. So he's in the 1% category. How does Depender, how do I help whoever wants to come in this category with whatever it is they don't have as background? And so there's a lot of that going on as well.
That's great. And that's great to see. And that's, and Jonathan, I think, building off of that, what did you think about when you talked about it being very difficult until you had your second company? And then what kinds of things have you thought about? And you have a very global investor base. So we'd love to hear your experience putting that together and how that's been.
Right. So I think there are these hubs that have this long tradition of innovation and understanding that, and it is very surprising. So I think as an entrepreneur, you got to leave no stone unturned, and you got to, pursue every path you can. But I think building on what Carmichael said, it's actually about how you build the syndicate, because you need it to fit. So for example, at Biomics, we had a first product, the company was actually, the Series A was led by, Orbimed, Takeda, J&J, very traditional kind of life science investors. But we kind of took an interesting, and that was like around traditional drug development, inflammatory bowel disease, that's Crohn and colitis, and that's something everyone can model, and so they would get excited around. But our program that made the most progress was actually in acne. And we looked into it and realized that after doing some analysis, the cosmetic path is more attractive than the therapeutic path. And we're scratching our heads like, we don't know anything about cosmetics. And, the folks from the pharma companies were like, why are you even doing cosmetics? And I think actually, just as an example, by building a syndicate, in this case of Korean investors that have a large presence and large holdings in some of the largest cosmetic companies in the world, it kind of changes the balance on the board and gets that appreciation. So it does, and you can envision how entrepreneurs sort of pursued and has conviction in a certain path, but if the investor's not with them, right, you will always need more money, and that's going to be the point where you get in trouble. So building that syndicate properly and building that skill set around the table makes a big difference. And it is changing, right? The world is changing very quickly. It's much more global. Just got to pursue the right, opportunities and build the right team, sort of downwards as well as upwards.
Yeah, I completely agree. I think, after finding a great idea and after finding a great team to get it going, I think the syndicate of investors is the next most important thing, and not to rank them in any order, but it's it is an essential ingredient to success. And I think that is also slightly different about this space because of again, over the last 10 or 15 years, as people have gotten used to very small rounds needed and very competitive and like 60 funds chasing, the same deal, if you may. This space has not been like that. It's been a very lonely space for many years. And now it's getting to sort of that healthy point where there's enough investors where you can build a good syndicate of 3 or 4 people at the Series A and 3 or 4 people at the Series B and on, so that the entrepreneurs have lots of different voices around the table. It's good governance so that it's not completely controlled by one point of view. And frankly, everybody makes a lot more progress because you have things to bounce off of. But I think matching the investors, to Jonathan's point, is very, very important. You don't want a mismatch. It's not good or bad. It's literally just like any other partnership, and a partnership that's probably going to last for 10 years, if not more. You want to make sure that there is match and everybody is pulling in the same direction. One dynamic that I'm seeing more, and again, kudos to Carmichael and their team, is the willingness for investors to share their due diligence. As you know, tough tech, or using your term here, does require a lot of deep diligence. And unless you do that, thorough deep diligence, you're going to make a lot of mistakes. In fact, I would say that was one of the problems with the first round of this, where people jumped in based on very shallow diligence, and this is a space that requires more diligence. And so rather than make entrepreneurs go through 5 or 10 serial rounds of diligence, I've seen more and more people, and I think BV has done a great job of that, of volunteering to share that. It all again comes down to a common purpose that says, when you look at the big picture and say, what will make this company and entrepreneur successful? And if you can pull that off, that is going to create so much more value than trying to have some kind of an edge against other investors. That edge is very short-lived, especially for those of us who've been in this for a long time and plan to be in it for a long time. Most of the good quality investors are not relying on one deal that's going to make or break their career. It's about building long track records and creating dozens of successful companies. And so I think with that patience comes good syndication. And I would encourage founders to really pay attention to that. And I would encourage other investors to pay attention to that.
One additional topic that came up when we were discussing investors and how things have changed are LPs and how they are approaching the space. Captive capital versus expanding to a more mainstream base. Dipender, you and I have talked about this as well. So, can you put on your different hats and maybe tell us a little bit about what you've seen?
Sure. So, okay, let's make sure that the audience, when you say captive capital versus other stuff, let me just, Meeta, if you don't mind, I'm gonna spell it out a little bit so people hear. You have LPs. They come in a lot of different shapes, sizes, and flavors. But if I were to kind of break it down, traditionally, if you look at a venture firm, where does it get its money from in terms of LPs, and certainly in the tough tech, hard tech space? And by the way, I got to give a shout out and congratulate the Engine and Katie for closing, the second fund as an aside. But when we think about the categories, they're family offices. Sometimes they're established as a formal office or as a high net worth individual. Second category can be a foundation. Third category could be an endowment from a university. Fourth category could be a fund of funds that manages lots of other people's money. A lot of times pension funds are too big, and therefore they'll give, for example, money to fund of funds. Sometimes pension funds all by themselves. And then occasionally we'll get the consultants who give advice and have lots of clients on their platform. And, an example would be sort of like a Cambridge Associates. And I'm sure I'm leaving out a couple of others, but those are pretty much the major categories, as I'm sure my colleagues would say here on this call. Every once in a while, you'll have just one of those. Maybe it's just a single family who's established an office and actually made a commitment to invest it in a particular category like venture, and you manage that one family's money. Or maybe you're an established fund where you have a few of those categories covered, but you have a conserved base that like follows you from one fund to the next, and really about 80% of your fund, your syndicate is the same, and the LP based. Breakthrough is highly unusual. We know, like we've got 20 plus billionaires who are all the investors there, and then by contrast, material impact is more traditional, where lots of those categories are covered. So anyhow, just as background, and it's all the same message. I got to say, something that Depender was talking about earlier, and I think indirectly Jonathan said it in his whole evolution of how one raises money in these sort of categories. If this was just 5 years ago, I would tell you the LPs. Let me be specific. I had the benefit of being at Northbridge Venture Partners, where I love my partners. They are transitioned out. All of them support me and have invested in things that I've done even to date, even this year. But I transitioned out, and they supported me to kind of do some new things, my own thing, and do breakthrough. I remember in the transition, me thinking, "Oh, is this nuts? I'm leaving this big platform where a lot of people I like to go do my own thing. What are LPs going to think about me working in tough tech, hard tech around topics like materials?" And I have to say, even though you absolutely put me in a positive light up here on this panel as someone that people should listen to, even I, for lack of a better term, had to explain 18 times to people that we could make money in these categories, that in fact, they should invest in these categories. And I was very fortunate eventually, like, the 19th time or the 6th time or the 3rd time, they heard me. But if and I'm sure Depender knows the same thing, but if we just 4 or 5 years ago had to explain to 90% of the traditional LPs that this is an exciting category, just imagine what so many others had to do, and probably with less success. Flash forward to 2020, even to 2019, is different. It's different now. Depender nailed it when he said, I don't know the numbers exactly, Depender, on how much money, is in some of these categories. I think you covered it, the scale of it. But there's so much money out there looking to come in this area because it's great business that makes a big difference. And so I'm finding myself again, just like with the entrepreneurs, just like with my co-investors, but also with LPs, spending a lot of time, happily, by the way, to help bring them into this category from a position of, hopefully for them, intelligence and getting on board. So I'm excited about, where the LPs are going. It's going to create a lot more competition for people like, the Capricorns, the breakthroughs, the material impacts, the engines, and so forth and so on. But I'm sure I can speak for Depender. We welcome the company. We welcome the what it's going to do to the industry overall and the collaboration opportunities. But the LPs it's quite different right now, just compared to 4 years ago.
So just a couple of things to add to it. I think Carmichael covered most of it. We did a similar transition about 5 years ago. For the first 10 years, especially because the space was so sensitive and politicized, and everybody was saying, you guys are all going to lose money. We decided, if you're going to lose money, it's easier to lose your own money, figuratively speaking. So we kind of did it with a small group of LPs. It was less than half a dozen. And after 10 years of feeling good about it and, realizing what we had always believed, that it was possible to invest in this and go toe to toe with any venture record out there, right? And any sort of asset class category that equivalent that Carmichael mentioned. We opened it up, and then we sort of went the other way, which was to really try and mainstream it as much as possible. So go almost as far away from what was a stereotypical assumption of people that, who was investing in this space. And so we went to all those categories that Carmichael mentioned and got investors and LPs from all those various categories, from hard-nosed pension funds, from hard-nosed hedge funds, from hard-nosed hedge fund managers themselves, from fund of funds, from consultants, from endowments, from sovereign wealth funds. And that's been really satisfying because this is a space in which not only do we welcome many more participants, we just know that for the bigger mission of where the world needs to get to with these solutions, we need orders of magnitude more capital flowing in different asset classes, right? And it's all going to feed into each other. Increasing the amount of venture capital is going to create a lot more new companies. Increasing the amount of project finance and debt is going to help scale that. In bringing, shining the light on public companies and stocks is going to help encourage those companies to also keep going in this direction. And so I think the mainstreaming is very important because those are the large stewards of capital, the largest stewards of capital who can actually move the needle on this. And so we are thrilled by this trend that this has started mainstreaming. And yes, there will be some waste as a result of it. But, that's part of that whole innovation process and that creative construction that needs to happen. And there will be some creative destruction along with that as well. And yes, the pendulum may swing and there'll be more money than is needed, but that always corrects itself, right, eventually. And keeping people out is more dangerous than having more people step in.
Well, I want to make sure that we have enough time, and this actually flows right into the liquidity that's available is, let's talk about SPACs a little bit. It's everywhere. According to our SVB's recent State of the Markets report, there are around 200 SPACs with $50 billion that are seeking targets now. And that's up from 59 through all of 2019. These alternatives have raised more than twice as much capital as 2019 and 2018 combined. So they're out there. It's happening a lot. And I think we have great panelists here to talk about it. So I want to start with you, Jonathan, because you have a great story to tell. And I would love to hear what your experience has been and any advice you have.
Sure thing. So we were actually approached by a SPAC sponsor last JP Morgan. Those days when we actually traveled to conferences, for those that remember those. And they approached us and started a conversation. I literally had to look on Wikipedia after the meeting what a SPAC really is. And, I did do my business school. So we had no idea what it is. And for those that are not familiar, it's basically a blank check company that you merge with. And they approached us. We had a conversation, being very conservative. I was like, no, why would I ever want to go public right now? No way. Went back, had a chance to talk with the board, again, going back to value-added investors, and had some of the savviest investors in the world on my board who said, Jonathan, what are you talking about? This is actually a really interesting opportunity. It's a good valuation. It's an influx of capital to the company. You should definitely explore it. Zip forward, we've actually completed a year ago going public with a SPAC. This was probably the first biotech SPAC in quite a long time. And these days, as you mentioned, I get calls from potential companies 3 times a week who are interested in learning more. Now, what's unique about SPAC, unlike going public, which is I think why people should take it very seriously, is first for entrepreneurs is relatively the level of certainty. So the process goes is that, you know, you can do a confidential roadshow and decide whether there are conditions that the company is satisfied with. And together with a sponsor of the SPAC, you can sign an agreement and sort of almost have the deal risk-free at the given price that you want to do the deal at a minimum amount of capital. And then you start doing all the heavy lifting of, you know, the paperwork, the S1, legal, accounting, and all that work, which, you know, we definitely did not sleep much the 3 months after that. But you do that, right? And it's a very distracting process after you know that the deal has been de-risked. So that is a key advantage. We've announced the deal in July of 2019, and then by October, it was all said and done, and we started trading. So I think that's a key advantage. There are two additional advantages that people should be aware of. The second one is that unlike a traditional IPO, when you pay proceeds in cash to the bank that takes you public, you actually don't. You give equity to the sponsor, which from a company, you know, in tough tech, which is always cash hungry, that's also an attractive aspect. And the third goes back, I think, to our discussion about quality investors, is the fact that the flip side of that, the fact that the sponsor is actually not getting cash, they're actually getting equity in the company, which is locked up for a certain period, means they're very incentivized to see that the company does well. So they're with you there in the trenches, and unlike a banker that's just got their cash and left, they're actually motivated to help you succeed. So I think we've been very happy with the SPAC experience. It was very interesting. It was very complex. So my word of caution, there's a lot of work, and it's not like a traditional IPO, and you need specialized, you know, advisors, lawyers, accountants that know how to handle it, because you cannot sort of just say, oh, I know how an IPO works and it's the same thing. It's not. It's an IPO merged into an M&A with its own quirks that one should be aware of.
Deepinder, I know that you've also done one recently. What resonates with what Jonathan just said with your experience?
I think Jonathan described it beautifully, and obviously having been through that process, reflected exactly what it takes. The thing that I would add is, in addition to what Jonathan said, is that I encourage companies that feel that additional capital is going to significantly change the trajectory of the company. So either, you know, enable them to do some things that they were not planning to do as quickly as possible, but were on track to do, like build a factory or come to market sooner, or do something in parallel where they were serializing something, and can really change that outcome. Because as Jonathan mentioned, running a public company is significantly more work than running a private company, and requires a whole level of, you know, professional financial management, reporting, things that are not that important in an early stage of a startup, and rightly so. You know, why should founders and CEOs have to worry about that before they really need to? So I think it's a balance where the fact that so much capital is available is a really good thing for most companies that are positioned to utilize that capital. And all the work that it takes to manage going public, and then managing, you know, the next 3 years before you are ready for a traditional IPO to be public, is well worth it if that capital can change your trajectory. I would not recommend using a criteria like folks needing early liquidity, because that could misalign a lot of objectives, right? So just for the purpose of liquidity, doing this could get people into trouble, and I think that's where you see some of the challenges where incentives are not necessarily aligned. But otherwise, I think if it's done in the right way, this is a great new tool. Now, I will say that you will see in a few weeks, months, stories of ones that are not going right, stories of ones that are mismanaged, stories of ones that are going south. Again, that's not that different than what happens in the real world, what happens with some public companies. And my guess is there will be a lot of noise around how this was highly irresponsible and done poorly, kind of like what you saw with the yield codes a few years ago in our space. And so anytime there is a rush of people thinking this is just too good to be true, there will be irresponsible versions of it. But I think there's a lot of good examples, and there will be a lot of good examples, and it will change the trajectories of several companies for the better. And then from an investor point of view, again, going back to the amount of capital available, there are many major investment firms out there who really like the ability to be able to deploy capital slightly earlier than they were used to. And the reason this enables them to do is because they're mandated to be able to only invest in companies that are listed. And so it's really I think the biggest beneficiaries of this are also some of the large pools of capital that want to participate slightly earlier in that stack.
Carmichael, do you have anything to add on that before we maybe get to some questions that viewers have had?
No, I think that what Jonathan did is set it up perfectly, and Deepinder filled it in from the investor standpoint. This is not directly to the SPACs, but Deepinder, you said this twice. I just want to reiterate that to the audience, which looking at this, and it's the general trend. Whenever you do something that's disruptive, lots of, and it's disruptive good, what ends up happening is you're going to have some examples of where some things fail. And, and I love that Deepinder flagged that. So the one thing I would say is what we should focus on with the SPACs, in my mind, are the examples of success, as much as the examples that like to get written about in the future, probably of, look at this mess, and, let's point this thing out, because, like he said it perfectly, that's normal business and everything. There's going to be things that succeed and fail. They got some people doing things responsibly, irresponsibly. That's the only thing I would say about this. I think the story here is one where we'll see successes and we'll see some failures.
Maybe one data point, just because I'm sure people want specifics rather than generalities, and I realized I used a lot of hand sweeping descriptions. For example, to that last point about doing it responsibly and doing it right versus people who take advantage of it, I think a good litmus test is if the company has no other way of raising capital but the SPAC route. I think that's a red flag. I think that's concerning, right? Because there you're now you're basically saying the bulk of the market doesn't think this deserves this level of capital, and you're kind of using a technicality to do it, and if you're able to do it. On the other hand, some of the healthiest SPACs we've seen have come almost immediately after or on the heels of a really healthy, large private round, where a private round has happened, the company is well equipped to achieve whatever they were set out to achieve for the next 2-3 years. And then the SPAC opportunity has essentially accelerated what was 5 years out or 7 years out into that 3 or 4 year period, right? And so instead of it being the make or break, can I raise any capital at all? And unfortunately, there are some examples out there today where there were companies who just were not able to raise money for several years and ended up being able to do a SPAC. And I think those you have to be concerned with. Now, obviously, even those companies can take advantage of the opportunity and fix things and come out well. But I have a feeling more of those will be in trouble than ones that didn't need it as the only route to raising capital.
Well, one very specific question on SPACs that just came in, and while we're on this topic, is mentioning the fact that recently they've really focused on mobility, storage, and hydrogen, and they're wondering if what's next. Fusion, is fusion still too early for a public vehicle, in your opinion?
I think rather than whether fusion is or not, it's more a question of how far away, right? So I would say right now, the investors that, by the way, are largely public market investors. So if you look at a typical list of investors who are investing in the pipes, for example, and that's an indicator, it's very similar to the investors that are going to invest in the IPOs ultimately. It's very similar capital. And so what you're seeing is those investors feeling comfortable about getting into companies 3 or 4 years earlier than they normally would see it in a traditional IPO. So maybe 2 years, maybe 3 years, maybe 4 years. I don't see investors getting into companies which would be 10 years from a traditional IPO, or even somewhere in between. So I would say, as opposed to whether fusion as a category is appropriate, I think more to do with the company. If the company that's doing fusion would be on a path to having a traditional IPO 4 years from now, I think they can consider a SPAC. But if they're 10, 15 years away, then I don't think it's the right thing for them.
I would also jump in and just say there's another aspect which I think, as Defender said, there's a difference between public and private companies, right? So it's all about, when you're in the public space, it's also about awareness. So you could be potentially, a fusion company with a very long horizon, but if there's hype around the company and there's excitement, maybe you can get more traction. So that kind of modulates a bit, I think the analysis of some of the investors, that they say, hey, these are going to be the next big thing, and we think they're going to make it. That's going to dial in, and people will have a bit more tolerance for, things that might take longer versus a company that no one knows about and has a longer, time horizon to get some data points. So that also changes a bit perception, and that's why, IR, PR is very important with these companies.
All right, I think we might have time for maybe 1 or 2 more questions. And I'm just looking at the ones. All right, so this is we can put SPACs aside for a second. And the question here is, some materials and process innovations take 10, 15 years to do. This is we know these are long cycles. So who are the best providers of capital for these types of innovations? And I think this question came in when we were talking about the new investors coming into the space. And so given that context, what would you advise?
Well, that could be an interesting one for maybe me to start for a second. I think so. This is not saying Breakthrough is the only investor, but I want to just describe the mindset a little bit. So Breakthrough, we're actually a 20-year fund instead of a 10-year fund. And for those who don't really may not get that, most VC firms are like, if I look at material impact for a second, they're traditionally more like 10 to 12-year funds when you look at the timeline. What Breakthrough is doing is highly unusual in the 20-year horizon. I think it's an unusual LP group, so to speak, with a particular mission. But one of our challenges is the fact that we want to get people who are in other categories who are not, the other 99% of the, investment community that's not a 20-year fund. And you want to be able to make sure that they get included along the way. So when someone says to me, it's going to take 10 to 15 years or longer to build a company, what does that really mean? I would argue that the biggest companies in the world have taken 10 to 15 to 20 years to build. And what you really want to see as an investor is you have your own thesis as to what are the value inflection points along the way. What you wouldn't want is for 15 years, the company to be worth the same amount with no progress, but all of a sudden you see a blip and all of a sudden it's worth a lot. What you'd want are to see progress that shows milestones being achieved, that could be technical milestones, products being sold, deals being done. And you know, that doesn't take 15 years, you know, not in most things, right? And you can see the business progress. And if that's the case, then I would argue you can build a syndicate based on, you have to pay attention to what the company does. I think fusion may be an example of a topic that is rare in that longer science horizon, you know, really long. But there are a bunch of other topics that along the way, you can see the progress in the business and you can see the value inflection points moving up along the way. And I think if that's the case, then you know, it opens it up for all sorts of people to invest. And they've just got to figure out, you know, based on what this business is, can I invest and you know, how long can I have my money tied up as long as I can see these value inflection points go up? And investors have portfolios. So they, you know, you may want to pick a company or two that you have your money, you know, locked up a little bit longer, but you can build a really big company. Like if I were to kind of throw it out there, going back to some dependent and I are both working on with, like you said, with Dave Danielson on our team is Redwood. I mean, I'm sure JB wants to build a very big company. We're super supportive of him doing that, right? And, but I'm also sure along the way he's going to achieve, that's going to take some time. But I'm sure along the way he's going to achieve some amazing milestones that would make it attractive for lots of different types of investors to participate. That would be an example. So like Dipender said, so we're not just talking philosophically, but we can give like a specific example of something.
So exactly right. And I think as long as that value creation continues to happen, the length of time is not a constraint. Obviously, everybody wants better, cheaper, faster, and you know get everything quickly. But there's a lot of patient capital that says it's well worth building a company that takes a long time. I mean, there's obviously people have heard so much about Tesla, so you don't need to keep repeating that. But you know, 15 years into it, we still own a stake in Tesla, and we intend to continue to own it. And it's similar with other companies. We have other companies in our portfolio that started with us 12, 13 years ago that you know we're very active with. And so there's a couple of ways to do that, which is hand off to other people who want to come in at later stages, as long as that value has been increasing. I think the part where it gets difficult is where for 15 years, the company remains a Series A type of a company or just, you know, has to keep reiterating. Then you have to recognize that something isn't working or it belongs in the academic environment or it belongs in a lab or whatever. So there can be always a thing that's too early. And then within mechanisms, you know, the first decade we did was with permanent capital and evergreen. And what we realized was, to Carmichael's point, these things were taking anywhere between, you know, 7 to 15 years. And so it wasn't that off from a 10, 12-year horizon, but just as a nod to making sure that investors didn't feel nervous, even the structured GPLP funds that we've created since the permanent capital has been in the 12 to 15-year variety, with flexibility to go longer, with flexibility to do special purpose vehicles with our LP base, which can extend those if the companies are doing well. And then recently we added another tool similar to sort of having that 20-year mindset where along with a 12 to 15-year early stage fund, you have a 12 to 15-year continuation fund for the companies that require that additional capital and can provide that value, which would be similar to growth capital. And so when you combine those two together, you can get 20, 25 years of runway across the asset classes. I don't think most of the companies are going to need that if they're succeeding, but that exists if it helps the entrepreneurs think a little longer term.
So we're going to have to end the conversation here. I just want to say thank you to all of you so much. I thought this was a great conversation. Up next, we have a 15-minute break, followed by one more round of founder pitches. And so to everyone who chose track C, thank you again for attending this discussion.